Hi everyone, welcome to ACCA Taxation video lectures. In this video lecture we are going to look at the self-assessment bit. Now this is chapter number 17 of both F6 and P6, so I'm making one single video because exactly the same material is both in F6 and P6. Now this is basically the self-read chapter, so there isn't anything technical in here. We will quickly go through with it so that just so that we don't miss anything. Right, so I would just share the screen with you through the screen share option. It is chapter number 17 of both F6 and I think P6 as well. So chapter name is self-assessment. I'm using the F6 lecture notes. Please make sure you open your I'm just sharing the screen with you anyway. So for P6 students, you should have you should go through your P6 notes as well after finishing this lecture. You'll find exactly the same material apart from one topic of capital gains tax paid in installment, I think. So that is not a technical topic anyway, so that is additional for P6 purposes. Anyway, let's start this chapter then. Chapter number 17, self-assessment, as you can see on your video screen. Now first of all it says keeping of records. Now record means that if you're a tax, you must keep the receipts. If you're claiming tax, you must keep the pay slips. You must also keep if you're charging any VAT, you must keep that records as well. So whatever sales you're making, you should keep them records as well, and your employees NIC numbers and everything. So you must keep the records, all the records. So it is a different period for the employee and for the businesses. So let's see what are these periods. Now all records required to enable them to make and deliver a correct tax return must be retained until 5 years after the 31st January following the tax year where the taxpayer is in business, and for employees it is 1 year. So for businesses it is 5 years, and for individuals, as the employees, it is 1 year. Now business means even if it is a sole trader, in that case as well he will have to keep it for 5 years. Now if you're not keeping it, for every tax year there will be £3,000 penalty, and after that it says correction amendment in the tax return. Now sometimes you submit a tax return. By the way, what is tax return anyway? Do you know the difference between tax return and tax payment? Now sometimes I'm surprised that few students do not understand the difference between tax return and tax payment. Now tax return basically is just filing thing. So there will be a form which you have to fill in, which you'll be giving the information of your earnings and the tax rates which will be applied, and you will be listing all the sources of income and everything. So it will be all the information which you are submitting to HM Revenue and Custom, and in which eventually you will know the tax liability as well. All right. So basically you are submitting a form. So you are submitting all the information to HM Revenue and Custom, and after that you pay the tax liability. All right. So it says that if you have done any mistakes in the return, you can make the corrections within 12 months after the filing date. So that's what it says, correction amendment in the tax return. So you can do the correction within 12 months. After that it says compliance check on returns. Now if HMRC guys, if they are in doubt that your compliance might not be up to the standard, you might not be keeping the records. Now they might visit you. Now an officer of Revenue and Custom has a limited period within which to commence compliance check on a return or amendment. The officer must give the written notice of his intention, and that would be within 12 months. So if the return is filed within due date, then by 12 months after the actual tax return filing date, April 30th, 31st of July, 31st of October, 31st of January. So these are the quarter days, 4 quarters, and after the anniversary of the actual tax return filing date. So whatever the anniversary of the first return date is, and whatever the next quarter will be, so even if it is 30th of April, 31st of July, 31st of October, 31st of January, after the 1 year has elapsed since paying the return, since submitting the return, so it will be that date. So HM Revenue and Custom officer must inform by that date. Normally it will be 12 months. All right. A compliance check may be made if there is a suspicion that the tax has been incorrectly calculated. Compliance check may also be selected on a random for an audit purposes. In the course of his compliance checks, the officer may require the taxpayer to produce documents, accounts, or any other information as required. After that, tax evasion and avoidance, we have done this in our very first lecture of F6. Tax avoidance is legal way to avoid the tax. Tax evasion is illegal way. After the ethical conduct of tax agents. Now we as a tax advisor must act ethically with professional behavior and integrity. If your client comes to you and he talks about saving tax illegally, and he says, I will give you a handsome amount of money if you help me avoid the tax in an illegal way, do not represent that client. Just tell them that it is not legal way, and if HMRC knows about it, it is a criminal offense as well. And we as a chartered accountants are not supposed to help such clients. All right. Now, if you already have a client, if you already have a client who was doing fine before, but then he thought, I'm hiding some income, I'm playing up with the rules. When you realize that he's playing up with the rules and he's trying to hide some income, you must write to them that do not do so. If you continue to do so, then you must write to HMRC. But of course, you will tell the client first that if you continue to do so, we will not be representing you anymore. And in that case, you will have to write to HMRC, but you will not tell them the reasons why you are no longer representing that client. All right, so you tell them HMRC that we are no longer representing this client. However, we cannot tell you the reasons. I mean, if you write like that, HMRC will already have an idea that why you are no longer representing that client. So they might start a compliance check or any other discovery assessment. All right. So that's what it says in the notes as well. So just read it yourself. On the next page, on page number 45, discovery assessments. If an officer of HM Revenue Custom discovers that income or profits have been omitted from the assessment, like any assessment has become insufficient or the reliefs have been given excessive. So if HMRC officer realizes that you are trying to hide some income or you are giving yourself excessive reliefs, in both cases you are trying to avoid the tax, an assessment may be raised to recover the tax lost. Normal time limit is 4 years, but it can be extended to 20 years. All right, where the tax is due to the deliberate understatement. Notification of liability to income tax and capital gains tax. Individuals who are chargeable to income tax and CGT will receive a notice to file return from HM Revenue and Customs. Normally, if you're chargeable person for the income tax purposes or capital gains tax purposes, HM Revenue and Customs will write you. They will give you notice. So they issue you a notice which you will receive by post. Now, in that, it will ask you to submit the VAT return. An individual who does not receive the notice to file a return are required to give a notice of chargeability to an officer of Revenue and Customs within 6 months from the end of the tax year. Now, end of tax year is 5th of April, so you must tell HMRC by 5th of October 2018 for our current tax year purposes. So within 6 months after the end of tax year. So you will write to HMRC that I have not received a notice of return. So you will tell HMRC. In that case, HMRC will then write you back, and they will give you the notice. All right. A submission of tax returns. Tax returns comprises a tax form together with supplementary pages for a particular source of income. The return can be filed electronically or by paper. Right, so the different dates if you are submitting by paper, and of course there are extended dates if you are submitting it by a computer. Now the time limit for submission of paper return is later of these two dates, 3 October after the end of the tax year, or so normally it's 31st of October. So normally it's 31st of October after the end of the tax year. In the normal cases, when you have received the notice return, when you have received the notice to file a return from HMRC, so it will be normally 31st of October. However, if you have, it will be 3 months after the notice to file a return in the case when you have received the notice to file a return late. Sometimes when you have not received a notice to file a return, then you will write to HMRC, I have not received the notice to file a return. Then HMRC will write you back and issue you a notice to file a return. So in that case, the notice to file a return will be received late. So in that case, you will still have 3 months. All right, so that's why it is later of these two dates. Likewise, limit for the submission of an electronic date will be 31st of January after the end of tax year, and 3 months after the notice to file return. So it will be 3 months extra as well in this case. So normally, what is the date? Normally, the date to submit the VAT return, if it is a paper based, it is 31st of October. If it is electronic, it is 31st of January. Penalties for late filing of tax return. Now, a tax return is up to 3 months late. If you have submitted the return up to 3 months late, then the penalty will be 100%. If the return is 3 months late but less than 6 months late, the penalty will be fixed at 100%. So it will be fixed at £100, but there will be £10 per day between 3 months to 6 months. All right. So between 3 months to 6 months means there will be 90 days. So if you're submitting on last day of the 6 months, your total penalty would be £1,000, because £10 per day times 90 days, so that would be £900 plus this £10 as well. Sorry, £100 as well. So total amount would be £1,000. Now, tax return is late by 6 months but up to 12 months. So it is less than 12 months but more than 6 months. In this case, penalty would be greater of 5% of the tax liability and £300. All right. Now, say for example, it is not relevant to the syllabus. I'm just telling you. Say for example, if you are the tax liability, if your tax liability is, say for example, I don't know, £200. Say for example, if your tax liability is £200 and you are late by 6 months, all right. So if you're late by 6 months, then your penalty would be £1,000 if you're paying last day of the 6 months. So your normal tax liability was £200. Now you are paying now you are submitting the return on the last day of the 6 months. So your total penalty would be £1,000. £10 per day multiplied by 90 days plus £100 as well. So total penalty would be £1,000 in that case. However, your liability was just £200. So the clever advice would be in that case just to wait for some more time as well. Now, if you wait for a couple of more days, so then you will arrive in the next rule, which is more than 6 months but up to 12 months late. Now, in that case, the penalty is 5% of the tax liability and £300. So it is greater of these two. So even if it is greater of these two, it will be greater would be £300, because your liability was just £200. So greater would be £300. So you would be paying the penalty £300, not £1,000. All right. So it would be clever. So if your client is late and their liability is less than £300, so you might ask them to just wait for a bit, so that if they delay for a couple of days, so they arrive in more than 6 months and less than 12 months, then they might be saving some tax. Right on. If you come to page number 46, please. On page number 46, please. It says tax return late by more than 12 months. If it is more than 12 months, then you will have to. The HMRC will determine if it is a careless. If you have been careless, then the penalty would be greater 5% of the tax liability, or £300. It would be greater of that. And if you are doing it deliberately but not concealing it, so you're not hiding anything but you're doing it deliberately, in that case it would be higher of 70% of liability and £300, and it could go up to 100% of tax liability and £300 if it is deliberate and concealed. Right. And just beneath that, the appeals are given. Now this thing as well we have covered in our very first video. Now it says that appeals are made first to HM Revenue Custom. If the taxpayer is not satisfied, then may apply to the tax tribunal. There are two tribunals: first tier tribunal and upper tier tribunal. Normally the cases are heard by the first tier tribunal. Complex cases are heard by the upper tier tribunal. If you're not satisfied with the decision of the first tier tribunal, you may apply to the upper tier tribunal. So if you are still not satisfied, then you might apply to the county court. All right. Right then, just beneath that it is a determinations. Now, say for example you have not submitted a VAT return, and if you have not submitted a VAT return, HM Revenue and Custom Officer will just pick a VAT return. They will enter your information in that, and then they will enter your sources of income as well. Now, HMRC officer does not know about your sources of income. They will just randomly write it down. So they can write it down £20,000, whereas your actual income would be £10,000. So they can write it £20,000, £30,000, whatever they think you are earning. So in that case, it would be very, very disadvantageous that so whatever the HMRC officer is writing in your return, so basically they are submitting the return on your behalf because you haven't submitted the return. So in that case, the information which the HMRC officer has written in the tax return, that would be considered your source of income, and you will be eligible to pay, you will be liable to pay tax on that. right? And just beneath that is a repayment of overpaid tax and repayment supplements. Now, repayment of overpaid, if you have overpaid some tax, then HMRC will give you interest at the rate of 0.5%. That is it, interest on the repayment. Now, what is the official rate of interest? Official rate of interest is 2.5%. If you have underpaid the tax, it would be 2.75%. HMRC will charge tax at the rate of 2.75% if you have been late. However, if you have overpaid it, then HMRC will be paying you just 0.5%. Is it fair? I don't think it's fair, because they are giving you 0.5% if you are paid more. If you overpaid, they are paying you 0.5%. However, if you're underpaid, they're charging you 2.75%. My goodness. On the next page, if you compare page number 47, this is payment of income tax and capital gains tax. Now, for income tax purposes, first payment will be made on 31st of January in the tax year. So our tax year runs from 6th of April to 5th of April. So whatever the 31st of January is, just before the end of tax year. So during our tax year, that is 31st of January. So say, for example, if we talk about the current tax year, which starts on 6th of April 2017 to 5th of April 2018, so our first payment for our current tax year would be 31st of January 2018. So 31st of January during our tax year. So that will be first payment on account. Now, a question arises that when we are making the payment during our tax year, we are not aware of our tax liability. How can we make the payment? So it would be 50% of the previous year's tax liability. All right, so we can make 50% of the previous tax year's liability. And then the second payment will be on 31st of July after the tax year. So if we talk about the current tax year of 17-18, it would be 31st of July 2018. So 31st of January is 31st of July after tax year. So that would be second payment on account. And 31st of January after tax year would be final balancing payment. So whatever 31st of January after tax year is, that would be 31st of January 2019 for our current tax year. So we'll make the final balancing payment. So what would be the final balancing payment? So we'll make first payment would be 50%, second payment would be 50% as well, and the final balancing payment would be, we'll have to see, by that time we will know our current tax year's liability anyway. So then we will see that how much have we paid, how much was our external liability. So if we have to pay more amount to HMRC, or we have to recover from HMRC. All right. And on the second date, on the date of balancing payment, which is 31st of January after the tax year, so that is the date of capital gains tax liability as well, if you remember. All right. So capital gains tax will be payable on 31st of January after the end of tax year. All right. So on final balancing payment, you will be making balancing payment. You will also be making payment on account of a tax year. You will also be making payment of capital gains tax. So there will be 3 payments on that date. All right. So first will be payment on account of the next tax year. Then will be balancing payment of the previous tax year, and also the capital gains tax liability on that date as well. So there will be 3 payments. Now, payment on account. What would be the payment on account? As I said to you, it would be 50% of the previous tax year's liability, but there are some certain additional things as well which must be added. So it would be previous year's income tax plus previous year's class 4 NIC less previous year's tax at source, and we'll take 50% of that. And final balancing payment would be current year's income tax plus current year's class 4 NICs plus current year's capital gains tax. Now it is adding capital gains tax here. If you don't want to add it here, you can do so, but eventually you have to pay it anyway. Less current year's tax deducted at source, less both payments on account. All right, so we'll deduct that. Whatever the payment is, we'll have to pay to HMRC. If it is a repayment, we'll have to recover. After that, it says interest on late paid tax. Now there is a typo in this one as well. Interest paid on late payment is 2.75%. It is not 3%. 3% was previous year. This year is 2.75% on late payment. All right. So please make sure you correct it. I will ask my assistant to upload the latest notes as well with the less mistakes, because there are a couple of typos in this one. Right, interest is charged on late payment for both payment on account and balancing payment. In both cases, interest runs from the due date until the day before actual payment date. So interest rate is 2.75%. And of course, this will be given to you in the exams anyway. Now, the tax rates are given to you in the exam kits as well. At the end of the exam kit of PPP, and for Kaplan as well, in the tax rate section, the tax table is given to you. Please make sure you are comfortable with that. Just look at that tax table. Wherever you're confused, just look at that tax table. That tax table will be given to you in the exam as well. Now, when you look at that tax table while you're preparing for the exam, that would be a good idea, because when you are in exam hall, you will know that on which page is which tax year. So when you're looking at the tax table again and again, you will have an idea that first of all it is tax bands, then there is NIC, and then there is corporation tax rates. So you will have an idea. It will be easier for you to search the relevant tax year when you're sitting in the exam. So it will save you some time in the real exam. All right. So that's why I want you to look at that tax table whenever you are preparing for the exam. All right. Right then, so the penalties on late balancing payment. The balancing payment, if the balancing payment is late, then the penalty will be paid. So the penalty would be 5% if it is more than 30 days, but within 5 months after the due date. And if it is more than 5 months but less than 11 months, it would be 10%, and it could go up to 15%. More than 11 months, if it is more than 11 months after the due date, it would be 15%. Right. Now, if you come to the next page, the penalties for errors are given. Now, there is a common penalty regime. Now, this is for all of the taxes, for income tax, capital gains tax, NICs, corporation, and value tax. So it is for all of them. Penalty range from 30% to 100% of the potential lost revenue. HMRC will determine how much is potential lost revenue. A potential lost revenues in simple language means that how much was the tax underpaid. So how much tax which they have lost, which is potential lost revenue for them. Now, maximum amount of penalty. Now, the amount of penalty for error is based on the potential lost revenue to HMRC as the result of the error. The maximum penalty, maximum amount of penalty for error depends on the type of error. Now, if it is a careless error, HMRC determines if you have been careless, then the penalty would be 30%. And if you have been deliberate but you haven't concealed it, in that case it would be 70%. If you have been deliberate and you're concealing as well, in that case it would be 100%, and 100%, 30%, and 70% of what? Of potentially lost revenue. Now, in certain cases, if you can prove HMRC that you were honest and you were not trying to play with the rules, in that case HMRC might give you a reduced rate of penalty. Right, so a penalty for error may be reduced if taxpayer tells HMRC about the error. This is called a disclosure. The reduction depends on the circumstances of the disclosure and help that the taxpayer has given to HMRC in relation to the disclosure. An unprompted disclosure. Now, what is unprompted disclosure? When you're telling HMRC about your error, when you know that HMRC does not have any idea about my error. All right. So if you're very honest, you will do what you will do is, if you're very honest, you will tell HMRC as soon as you have found that you have made an error. So you will tell to HMRC as soon as you have found the error. Now, in that case, you know that HMRC does not have any idea about your error. You can hide if you want to, but you are being honest and you are telling HMRC. So in that case, that is unprompted disclosure. Now, the other one is prompted disclosure. In that case, you have done the error, you have just kept quiet. You did not tell HMRC. Then you came to know that HMRC has made a discovery assessment. They might come to you. In that case, you have disclosed to HMRC, I have done the error. Now, whenever you are doing this disclosure, now that was late disclosure, because at that point, HMRC was coming to see you. You were scared, that's why you disclosed to HMRC. So that was prompted disclosure. So when you're doing unprompted disclosure, of course, the penalty would be reduced. When it is unprompted, then the penalty would be reduced. When it is prompted, it would be more penalty. All right. So an unprompted disclosure is one made at a time when the taxpayer has no reason to believe that HMRC has discovered the error. Otherwise, the disclosure would be prompted disclosure. The minimum penalty can be imposed as follows: if it is an unprompted disclosure, and if it is careless, you have been careless, then the penalty would be 0%, and it could go up to 30% if you are deliberate and you are concealing as well. And if it is a prompted disclosure and you are concealing and you have been deliberate, it would be 50%, and it could be 15% as well if you've just been careless. All right. Right then. So that's it for this video lecture. We have finished our self-assessment. I don't think there's anything else in this chapter. We are finished with that. Right, so that's it for this video. As I said you earlier as well, it is exactly the same material for F6 and P6. So you, for P6 students, you just have to go through your P6 notes, this chapter, self-assessment. All right, so I will see you in the next video lecture, and we will continue with our journey of taxation. Goodbye.